Good Friday morning, Market Chameleons and all those joining us for the first time. Thank you for checking out Market Chameleon, and here he is, the King.
Good morning, Will. How are you?
Good. You want to start with the disclaimer? It's up and ready to go.
Yep. Oh, you know what? Hold on one second. I have to put in my speaker.
All right. Well,
I'm better.
Popping his speaker in. We do have a webinar coming up with Raj. He does one a month. He's an active Chameleon user and a big participant in the Discord group. I haven't mentioned that Discord group. If you're watching us for the first time, there was a Discord group created by a couple very active Chameleons. And if you want a link for, I'll just pop the link into the YouTube chat. While I'm mentioning the YouTube chat, I did put a link to the Zoom meeting. If you have any questions about what Dima is talking about today or anything about Market Chameleon, come on over to the Zoom meeting and ask that question by raising your hand, and I'll let you turn on your mic and you can ask it verbally, and it will lead to a more open and great discussion about your question. How's that, D?
Awesome. Thanks, Will. How does this sound? I just plugged in my speaker.
Sounds great.
Good. All right. So everyone, thank you for joining. Before we get started, keep in mind Market Chameleon, Will and I, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. If you need professional advice, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. And
now, just a couple other things. What you're going to discuss today came from a question that someone asked yesterday on the chat about Skew. And I gave that over to you, and you've come up with something about Skew. And yesterday's question about the unusual option activity was actually another Chameleon sending that to us. So those we read everything you guys email to us, so it's super helpful. And thank you for doing that.
Yeah, so sometimes people will ask questions on the show. That's what we're here for, to take those questions. A lot of you were brave enough to come over to Zoom and ask the questions live. Some email those questions, so I try to go through the emails, and I could put them, discuss them, or incorporate them inside the show, or I try to reply to as many as I can. So this one, well, I think, what was it, at the end of the show, somebody was asking about Skew.
Yes.
Or emailed over. Yeah. So what was the question?
Let me I sent it over to you. I'll get the exact question.
Take a look. All right. Well,
the question was, does Skew forecast future stock price activity? If so, can we scan for Skew opportunities? Was the question.
Okay. So there are like two parts to that question about, like, what is Skew trying to forecast and how do we scan for Skew. So I'll take those today, and then any other questions along the way will stop me, let me know. Okay, I'm going to share my screen real quick. There we go. I'll start out taking a look at the pre-market report, and then we'll go on and discuss Skew. And I think I feel like a week ago or so, we were talking about Skew. Maybe, I guess I didn't finish, or just go to a place where you could start scanning for it. So that's what I'll do today. All right, but I'll do a quick recap about implied volatility Skew. So let's start out pre-market report. These are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I see 45 stocks made our percentage gainers list, 152 on a percentage decliners list. So, 3-to-1, their ratio, many more decliners. So we're looking right now like we're going to, open lower. There's a bearish bias at the open. Let's take a look at the S&P 500 stocks, and we'll take a look if there's a similar situation. I'm going to the filters above. Using these filters, that applies it to all the stocks that are in this report. So by selecting SPY ETF, we're going to filter this report by the components or the holdings in the SPY ETF or S&P 500 ETF. So looking at that, we got 3 stocks that made our percentage gainers list, 22 on the percentage decliners. So That looks more bearish at the open. Okay, so the bit more bearish bias at the open. I'm going to go start going into the skew, Will, and stop me if you have any specific questions.
Will do.
So really quickly, let me recap what skew is, what the implied volatility skew is, and then I'll go over, where we could scan, because I think the question also came from somebody may have asked a similar question about reverse skew. So we're going to take a look at that. But a skew, maybe, let me go to Apple. And I'm going to go to the options chain. And so right now I'm on Apple's options chain. And let's go out to, I'm going to select one of the expirations, January 22nd. And what the skew here is doing, what does the skew mean? Okay, so let's first discuss implied volatility and then implied volatility skew. So when we look at the options, right, on the board, we have all these bids and offers, and these options represent premium people are paying for certain right, calls or certain puts. And just by looking at the prices alone, it doesn't tell us a lot about, are they expensive or are they cheap? We have to kind of convert the prices into certain benchmarks and certain metrics that we could measure against history. And that's where the Black-Scholes model comes in, where we could plug in the prices and work backwards to say, well, what is the implied volatility of this particular option? If there's a bid for this 185 call, 275, if we put in all the inputs like days to expiration, dividend assumptions, interest rate assumptions, all these assumptions, what do we think the implied volatility is? And then it gives us the implied volatility. What is the implied volatility is telling us, let me come back a little bit, so the implied volatility is telling us that if we assume this price for this option and everything in Black-Scholes, then the expected volatility in this stock from now to expiration is 33.8, right? That's what it's telling us, that this is the expected volatility or how much the stock will move around, right? So the Black-Scholes model doesn't look at direction, it looks at the volatility of the stock moving around, the gyrations. The reason is the Black-Scholes model says that you don't need to take a directional risk because you could hedge the direction using your deltas and then gamma, vega. So you have all these Greeks, you could hedge that off and you could just hedge off the directional risk, and you have your volatility risk. So you could trade your implied volatility versus your realized volatility. That's how the Black-Scholes model works. And what it's saying is that based on, where the option prices are, this is assuming this is the daily average implied volatility the stock will trade at. So why do we have a skew? And I'm going to look at the skew within expiration. You have a skew that goes from one expiration to the next. So you could see here are different expirations. Each of them has a different implied vol. But you also have all these different strikes, and they have different implied volatilities. And the question became as well, if the stock, the stock itself, if from today to expiration is only going to have one volatility, right? It doesn't have a lot. It's not going to have, 20 different volatilities. It's going to just have one. So if the stock is only going to have one volatility, why are there different implied volatilities on each of these options? And the Black-Scholes, the people who created the Black-Scholes, right, they thought this was an arbitrage, because they're like, well, if the stock only has one volatility, then the options must be mispriced according to their model. And they're saying that you could buy the cheaper vol, sell the higher vol, and then you could trade the Black-Scholes model by staying delta neutral and gamma, and you should be able to make the differences over time. And that proved to be wrong. They almost went out of business with what was it, long-term cap?
Yeah, it was long-term capital that was, I think, making that bet over and over and over again.
Right.
And when the market exploded to the downside, it caused a lot of issues. And I think on the other side of that, I think Jeff Yaz and Susquehanna were taking advantage of the flat skew, and that's how they made basically
their
fortune that led to the growth of Susquehanna.
Right. So what, and the reason for that, right? And you're going to see skews everywhere, no matter where you go. It's hard to find a flat skew. They exist, but it's hard to find. There's usually skews. And in the market, the reason for it was that, yes, the stock will have one volatility, but the volatility is expected to change based on the direction of the stock's moving or the path that the stock is moving in. So if the stock continues to move higher, then if we look at SPY, the expectation is that it's gonna slow down and the volatility will be slow because you get a lot of people then sitting on the offers, a lot of stock that people buying are not panic buying. Nobody needs to buy a stock, right? You might need to sell it, but you don't really need to buy it, right? It's not like food or water, or you don't need to buy it. So the idea why the skew that if you're going up, the volatility started. If we look at SPY, volatility is expected to slow down. It's not going to move as fast, but on the way down, it can move fast. It can move down much more violently, and the volatility, there's more uncertainty, and the volatility will increase depending where the stock moves. All right, so the expectation of volatility changes depending which way the stock moves, and that's where we get that skew to the downside, and we can see it mostly in SPY, but I see here a little bit in Apple, right? The implied vols are moving up as you go down, moving down as you go up in strike prices. And then that's kind of in a fast explanation why there's a skew. And how do we measure the skew? Well, there are different ways to measure. So let's look at one way is we could take the money. So, right now we're at 172.26. So kind of like in between there, 170, 175. And I see that the volatility, implied volatility is around, I think like around 34. So if I run a straight skew, if I say I'm going to take 34 and I'm going to apply 34 to all the strikes, right? If I do that, oops, I don't know what that is. Hold on a second. If I do that, then how much am I paying over? Or I don't know what this is. 1 second. We'll have some kind of an alert come up. And I don't know how to turn that off.
What type of alert is it?
I don't know. I think I just upgraded my Windows, and I think that they just sent me like a news.
Oh, because I got an alert on my phone too. Exposure to COVID notification keeps popping up. I don't know what that means.
Okay. Well, so yeah, I don't know. But so I'm gonna run. Let's say I'm gonna apply 34 skew on there, right? I'm sorry, 34 implied vol. Press OK. And if I run a straight skew, 34, 34, all the way up, and I say, well, if I go to the 25 delta call, right, and I think that the 25 delta call should be 34, what is it really? Well, let's say it's, it'll be like 35. and then 25 delta put, instead of 34, it's 39, then I could see how much skew is in the put and how much skew is in the call relative to a straight delta, right? Like a flat, I'm sorry, straight volatility, straight implied volatility. So that's one way to measure how much are you paying over, for a put or call or under relative to the at the money implied vol, right? So you need benchmarks to measure the skew. So let's keep that on a straight. If we apply a straight skew using at the monies, how much are the 25 delta puts over? How much are the 25 delta calls? And then we could see it. Here's a example here. So I'm going to come here. In here, each expiration has a different skew. So here I could see, well, using an at the money implied vol, how much are the puts over? So here they're over 3.9. And how much are the calls over? So it looks like the calls are not over or under. They're kind of, the 25 deltas are kind of in line with that. The money, just the puts are skewed a little bit higher. Here, the calls are skewed a little bit lower, but the puts obviously much more built in than the calls are discounted. Okay, and that's on a straight skew. So let's take a look at SPY. So here's SPY. We see that the puts are 23% premium, right? From December 27th, 23.7% premium to the at the monies, while the out of the money call, the 25 delta call, is at a 14% discount to the at the monies. All right. So that's how we're looking at the implied volatility skew relative to the at the monies. All right. So that's one way to measure them. And this is not unusual. This is kind of what you usually see in SPY, or you see, different skews for different stocks. Sometimes you see some of them have reverse skews, like the VIX, right? The VIX will have a reverse skew because when it goes up really fast, violently. But when it comes down, right, it's like the opposite of SPY. Going up, it comes down slowly. Okay, so the VIX let's take a look at VXX. So VXX is the ETF. So we see here the reverse. Downside put is at a discount. Upside call is at a premium. All right. So any questions so far with that, like what skew is?
Nope, you're good.
Okay. And that's kind of what the skew is telling us, is that based on where the stock, where the market's expectation, if the stock is going in this way in the VIX, if the stock's going to go lower, the markets are expecting volatility to decrease. So whatever they're saying the implied volatility is now, it's expected to decrease as the stock's going down. In this situation, in the VXX, if the stock is going to increase, the volatility is expected to increase as it's going up. So I think that's the first part of the question. Like, what is the skew telling us about the future price activity, right? Price action. So it's telling us how it expects volatility to change based on the direction or the path the stock starts to take. Okay, so if you're okay with that, if there are no follow-up questions, I'll go take a look at a way to screen for it.
Perfect.
Okay. So I'm going to use, because every expiration has its own skew, right? So you could see here, December 17th, there's a different skew than December 23rd, January 14th expiration, there's a different skew. So if we kind of take a look at the skew, maybe, one way to do it is just screen by expiration. So I'm going to use this screener here, options by expiration. Oops, hold on, didn't click on it. And this screener here, we have the data below. We do have different tabs with different data sets. And what this screener is doing is analyzing it by the expiration, right? So it's not doing 30-day, constant maturity IV. It's not looking at a specific option. It's looking at the by particular expiration. So if I put in SPY, you're going to see a bunch of, right? It has all these different option expirations. So we're looking at the money vol for each of these individually, the volume based on this expiration, open interest on this expiration, the implied volatility straddles. This is the expected move of the stock based on the straddle. So next 3 days, we're looking at December 20th. This from yesterday's close. The straddle is implying that the stock will move 1.3% in either direction. And this here is the dollar amount it's expected to move, right? So in the next 3 days, that straddle, $6.11 in SPY for December 20th. You can see December 17th expires earlier. That's expected to move 1% or $4.49 in either direction. So that's the straddle, right? So we're going to go towards the skew, but just to give you guys the idea of what's going on. So I'm going to take SPY off so we could bring everything back in. So we see you have 35,000, over 35,000 rows of data. And we're going to go here to skew. And in the skew, what we're going to do is, let's take a look at let's explain the data. So here, got symbols, stock price, price change, the expiration, that the money vol, change. So we see this one, it's a very low price stock, 26 cents. There's no volume in it. Those are and maybe the options are even wide, but those are harder to actually gauge to make estimates. So let's do this. I'm going to first filter out options, volume over 5,000. So at least 5,000 contracts have to trade on that particular expiration in this stock. So we're getting like a little bit more liquid where there's activity. I'm going to also just make the spot price, let's do it above 10 bucks. Right. So this way, I don't want any dollar stocks, $3 stocks, penny stocks. Let's just go look at a little bit higher price, at least 10 bucks. So we got that filter, those two filters right now. Okay. Spot price, option volume. So these are over 5,000. This has to be over 10 bucks. Now here are a couple metrics that we're measuring the skew. So the first one is we're taking a straight implied vol, like I just showed you guys, and we're measuring if on a straight vol, if we looked at the 25 delta put versus that the money, is it over or under and by how much? So in this situation, it's over by 1%, not a very big skew. And what about the call? So if we took the at the money and we said, we compared the at the money implied volatility to the 25 delta call, how much is that over or under? And that one is under by 1%. So very close, 1% is not a big, it's not a big skew. I would say it's almost flat. And then we could also look at, well, what about the wings versus each other? So I could compare the 25 delta put versus the 25 delta call, and we see there's a 2% differential, right, between the two. So that's really quickly giving us metrics about the skew in SWKS on the December 17th expiration. We know that the implied volatility is 65, and we could see really quickly how the wings where the wings are relative to the at the money and versus each other. Okay. And that's where we kind of start to see this. So let's do this. I'm going to sort this. I'm going to use the 25 delta put versus the 25 delta call. Let's just sort this and look at the top one. So in ESSC, right, the stock's $12.22, implied vol is 121. I see that the put is offered at a discount. So downside put is offered at a discount to that the money. The call is at a premium, right, to the at the money, and we see that the put relative to the call is at a 46% discount. So this is a reverse skew. This was telling us that the upside calls in January 21 expiration are bid higher, downside puts lower. Right, so let's take a look at that one. I'm going to go to ESCC. I'm going to show you how that looks. And I'll tell you what tends to, from my observations, tends to happen. So here I'm on ESCC, January 21st expiration automatically picked. And here we go. So the stock is $12.22. So like right around here, 12 and let's say 12 and a half, right? So what's going on here as we go up in price? We see implied volatilities are increasing, right? And as we go down in price, we see implied volatility decrease. So here's the implied volatility on the 10 strike. It's in between 78 and 92. And as you go up, you see that implied volatilities are increasing. So let's just take a look at it. You could see it visually here. You don't have to reference the implied vol, but if the stock, look, if it's at $12.50, right? And you think going down $2.50, right? You're protecting yourself at the 10 strike. It's 45 cents, right? 45 cents, and you're protecting yourself down percentage-wise, 18.2%. But look, so if it was the equal, right? If you think it's going to have an equal chance of going up 30% or down 30%, you would think then I'm going to go up $2.50 and I should be having the same, the premium should be almost equal, right? But it's not. Look how much higher these options are, the 15 than the 10. Distance wise, they're almost the same. Look, from 12 and a half, I'm going all the way up to the 25 strike. So this is over 100%, right? It has got to go up over 100%. Look how much higher these options are, 85, 95 than the 10. So you could see the skew here, right? That the upside calls are bid way higher, right, than the downside puts. Everybody kind of see that? And let me know if not. So what is the market telling us? And this is what my observations are usually. When I see this, this is usually what happens. The market's telling us this. There's a chance that if the stock goes up, it's going to go up really fast, violently. Okay, that you're not going to get to really hedge it on the way up. Like it could do something like GameStop, or what are a couple of those stocks that just started going up and you couldn't, it was almost like a short squeeze. It went up very violently.
Yeah, it was GameStop was one, AMC was another. They were right. Referred to as the Reddit stocks because it was a community driven buying program that led
so that's what it
ripped the face off of Wall Street professionals or stocks.
Right. So that's what the one side is telling us. The other side is telling us though that as I'm watching this decrease, that this stock is probably overvalued and it is more likely to go down than to go up. So when I see this skew, this is what it's telling. From my observations, from my experience, the stock is more likely to go down. Okay. But in the event that it goes up for whatever, it could be very illiquid. Okay. So it could be very liquid and there's not much out there to stop it if there, if you have whatever it is short squeezing, it could go up very violently. There's just not enough, out there. But right now, the skew is telling me that it's more likely to go down than to go up. And that's kind of like how I'm seeing it. Okay. Now, on the flip side, it's very dangerous on the, that's why people are buying these to the upside, right? Because it's very dangerous. You don't want to be shorted.
Well, the upside, there really is unlimited risk, right?
Yeah, exactly. There's an unlimited risk. Exactly. You have enough people in Reddit or whatever buying this. Maybe it's a buy. Let me just take a look. Is this a biotech stock? It's a shell. Okay, so it's a shell company, and I don't know much about it. Maybe I don't know if they announced a merge or what is. I'm not sure what's going on.
It's probably one of these. Probably one of these SPACs, right?
Yeah. So right. So I think it's kind of like with GameStop or whatever, that at least market makers in Wall Street, they probably think this thing is overvalued, deserves to go down, but they at the same time they're seeing some kind of unusual volume there or illiquidity to the upside that's allowing them to say, hey, I'm not going to be able to hedge this to the upside, if I'm short.
Hey, D,
Great
show. It's trading day has started, and you've actually your mic has gone underwater. So
sorry guys. So well, thanks everyone for joining. Stay safe out there and have a great weekend. Have a good trading day. Hope you guys on Monday.
All right, we did get a question from Trevor who was asking about why 25 delta put and 25 delta call. Maybe we can answer that on Monday. Everyone have a great trading day. Dima, great job as always. Thank you, Chameleon community.